Hey everyone, it's Janine here, and today we're going to be talking about how much you need to save for a down payment on your home. Buying a home is very exciting, but with that comes the financial stress of trying to figure out how much you should actually be putting down on your home before you take possession. In Canada, you're allowed to purchase a home with only 5% down if your home is under $1 million in purchase price. I think for a lot of us, that's probably going to be the case. That being said, you might want to consider putting more than the minimum down of 5%, and here's why. When you put less than 20% down on your home, you're going to have to pay CMHC, which is home insurance for people that are putting down less than the 20% that has typically been required over the years. This is not a small amount, and I've linked a calculator to the cost of CMHC based on your purchase price and your mortgage amount in the comments section below, but it's really important to make sure that you're considering this when you're determining how much to put down on your home. The more you put down on your home, the smaller amount of CMHC you're going to pay. So it's in your best interest to create as large of a down payment as possible. The scales tend to tip when you put down at least 10%. So it's important to try and reach this goal when you're entering into home ownership. What tends to happen when you put down less than 10% is the amount of CMHC you pay ends up eating into the equity in your home, which means if you only put down 5% and then you have to pay tens of thousands of dollars in CMHC, you're really only going to end up owning about 1 or 2% of your home after it's all said and done. While it is a daunting task to save up 20% in some of Canada's hottest housing markets, it's still very important to make sure that you have a substantial amount down so that you aren't eating into that equity and wind up underwater on your home. If you can aim for at least 10% down, you'll mitigate how much CMHC you're paying, but obviously you want to try and shoot for that 20% down so that you aren't paying anything extra on top of the cost of your mortgage. If you're looking for places to save for your down payment, there are a few to consider. If you're planning on purchasing within the next year or so, you might want to consider something like a GIC or a high interest savings account. And this is because they're low risk and you aren't going to lose the value of your down payment in the stock market. If you're 4 or more years out from purchasing your home, you definitely want to consider investing that down payment so that it can help grow how much you're able to put down on your home. Places like your RSP so that you can utilize the home buyer's plan, or even your TFSA if it's long-term, can be great places to invest your down payment. That being said, you definitely want to try and use your RSP first when you're putting in a down payment as opposed to your TFSA. Within those investment accounts, you're going to want to invest in balanced funds that allow you to have steady growth over the years that you're saving for your home. These balanced funds can include things such as index funds or ETFs or even mutual funds to make sure that you're getting a well-diversified portfolio that won't dip down with some of the ups and downs of the stock market. Lastly, if you're saving for a down payment, you're going to want to save for some of those closing costs as well. Things like an assessment, an inspection, legal fees, as well as any property taxes the owner may have already prepaid are going to be your responsibility. So it's important to make sure that you save this amount up as well and make sure you have it as cash in your bank account. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. And if you have any comments or questions around saving up for a down payment, please leave them in the comments section below.